It's very difficult to comment on the politics, but what's clear is that investors don't really know how to position themselves, right? Whether you buy, for example, the spread between Spain and Italy, whether you go Spain and Germany, or even in Italy and Germany, because Italy's probably next in line with uncertainty in politics. How do you hedge?
Well, I think so far the base case is that this complicated political situation remains peaceful, and I suppose this is, the key starting point. And when you look at the Spain versus Italy spread, in fact, throughout this year, it's been relatively stable, which means that the level of nervosity is still fairly low. For us, we think it remains a localized event. We do not think this is a reason to review our forecast in terms of Europe or monetary policy, and therefore the impact should remain contained. Oh. If anything, we've used some of the volatility to benefit from better entry points on bonds like Catalonia, for instance, where we would be, willing to buy.
I mean, euro dollar, and I'm actually a little bit surprised, 11778. Is the euro going to take some of the brunt of this? Again, you think this is localized? I don't know when people start worrying about Italy, because we're unclear of exactly what will emerge from the next elections that have to happen in the first quarter of next year, and also what happens with Brexit.
Yeah, so on the Italian front, the new electoral law, if anything, has reassured us even further on the risk on the Italian front. Mm-hmm. The fact that the euro is a little bit weaker, if anything, will be seen as good news by the ECB. We know it has a great impact on the earnings of European company, and a too strong euro is not positive for the growth of the area. So I would say, in the same way as the French election made the euro a little bit weaker, this is in fact good news for Europe in general in terms of growth and financial assets. A weaker euro is positive for the European stock market, so long as these conflicts remain peaceful.